Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make a little bit of money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. On Wall Street, we've all been conditioned to believe that good news is bad news and vice versa. Maybe if the economy is too strong, we can expect the Federal Reserve will raise interest rates, bad for growth, and if the economy is weak enough, the Fed will cut rates. Good for growth and the stock market. But sometimes bad news really is bad news, like the very weak employment numbers we saw this very morning, something that shows the economy is producing far fewer jobs than expected. Like many others, I was rooting for a weak labor report in hopes of lower rates, which usually means higher stock prices. Unfortunately, we got something so weak, I didn't want that it feels like even lower rates won't resuscitate things, which is why the Dow went up initially. But then when people looked at the numbers, they realized they weren't so good, and it lost 220 points. S&P shed 0.32%, and the Nasdaq declined 0.03%. And that's what happened today when we discovered that this gigantic economy is simply not creating jobs in any meaningful quantity. And the Fed may not be able to stem the tide with just a quarter-point cut, which is what's expected. If that's true, then corporate earnings may be coming down, and credit, which has been robust, might get tighter, leading to rising defaults, hence why the banks led the entire market lower today. Sell, sell, sell. Now, before I talk about what's coming next week, let me put in a little ray of sunshine in the equation. I still think bad news is only going to be good news because unemployment isn't really spiking. We have lackadaisical job growth, and rate cuts will stimulate the weakest part of business, which is housing. I always say that housing punches above its weight in the economy. Because when you build a house, a lot of things happen beyond hammers, nails, and wood. The process of buying a home entails endless different kinds of transactions of the financial retail variety. Home sales, by the way, are currently at a more than 40-year low. Conversely, $1 billion, say, of dollars being spent on building data centers. They can be erected, but that puts some people to work. But once they're up, I tell you, it only takes a handful to run them. I've been in one. Sure, you'll use a lot of chips from NVIDIA and Broadcom, what a stock, and tons of metal racks and concrete, some cooling equipment, maybe plumbing. But beyond that, not much at all. Homes, on the other hand, allow all sorts of companies and all sorts of people, skilled and unskilled, to be put to work. After all, artificial intelligence still can't hammer a nail or hang a roof. So I'm not going to be a doomsayer here. I will say, though, that lots of stocks have moved up a great deal, and sometimes we forget that we are indeed in the month of September, when money managers look for any excuse they can to ring the register. With that in mind, let's take a look at what's on tap for next week. Okay, we're going to start Monday with one of the best retail concepts around, and you may not know it, but I want you to learn about it. It's called Casey's General Stores. This company has 2,900 convenience stores in 20 states and a breakfast pizza that's more than just a gimmick. We love these guys. Now, we can make a ton of money owning an outfit like Casey's that dominates in the smaller towns that it operates in. You know, we had Casey's on back in June, and I was stunned at how loved their stores were. And I tell you, I was stunned about how much I like the breakfast pizza. And we were thrilled to hear that the regional going international story is alive and well. They report after the close. I'd be willing to buy some both before the earnings and after. It's just the kind of out-of-the-way story that could work in this tape. Not worried about tariffs here. Tuesday, Oracle reports, and for the longest time, Oracle could do nothing right as a software company. But ever since it reinvented itself, or more accurately, ever since Larry Ellison and Safra Catz turned the place into a data center kingpin, it's been doing nothing but net. You saw some of that excitement today when Oracle stock jumped more than $9 on news of a further expansion in their data center strategy. Remember, right now the market's turned fickle, so it's entirely possible that a good set of numbers will spur profit-taking in Oracle's smoking hot stock, unless the results are truly incredible, like the aforementioned Broadcom, which delivered amazing numbers last night. It may not be enough to move the needle. Now, here's something that could move the needle, though. Apple. Yes, Apple's rolling out the iPhone 17 line of products, and I like what I'm hearing, which is crickets. Yes, it's supposed to be what's called an awe-dropping event, but like so many things that Apple does these days, nobody on Wall Street seems to care. Good things the rest of the world does feel differently and does care. Apple remains a maligned company with the best pure product set in history. And as long as that's the dichotomy, well, you probably know exactly what I'm going to say. Own it, don't trade it. Here's one worth watching, drone maker AeroVironment, which reports Tuesday after the close. We had them on when they reported last, okay? And I love what I heard, but I felt like I was alone. The stock was doing nothing, even when it dipped. Then, oddly, when I talked it up on Squawk on the Street, the darn thing levitated, and it never came back down. I said right here, and you can see. Nice move, huh? The defense budget is rapidly evolving. We recognize that drones are a more efficient way to make war than other, let's say, than how about $100 million fighter planes. Again, like Oracle, a good number could be met with profit taking, but I'm mindful that AeroVironment's got a terrific story to tell. You know what doesn't? GameStop. Its chief claim to fame is its surly chairman and CEO, Ryan Cohen. Maybe he has something to say. Maybe his acolytes and minions will care. Or maybe GameStop will once again find a new way to disappoint. If this market's going to shrug off today's bad is bad rubric, we'll have to see some good news on the inflation front, something that will allow the Fed to cut interest rates more aggressively than we think they're going to cut right now. I don't know if that's possible given the fluid tariff situation, but we will know when we get the producer price index on Wednesday morning and the consumer price index on Thursday. Tame numbers could reset the narrative. But again, I caution that there's nothing bullish that really happens throughout much of September, just sporadic moments. On Thursday, we hear from Kroger, the supermarket giant, and it's a much like story in part because it's been able to hold prices down for the consumer. I'm more keen on Costco and Walmart, as you probably know, but Kroger's been known to rally on good numbers, and I think he can deliver again this time around. However, I am not sure about the stock of a one-time fave of mine, Adobe, which has fallen dramatically out of favor, not unlike Salesforce, which reported a big upside earnings surprise this week. But it meant nothing for the stock, ostensibly because it didn't lift guidance enough, but more likely because the Wall Street fashion show has turned against their software as a service business model, like Adobe has. Why? Because money managers are under the impression that this kind of model is vulnerable to artificial intelligence competition. Lost in the shuffle, Adobe's got the best product. I no longer think that may be enough to propel the stock higher. Come Friday, well, this is what typically happens. We're most likely to have to get back into the habit of expecting tariff news, perhaps the long-awaited semiconductor import duties. It's been hanging over us. Maybe we'll get deets. The sooner we're finished with the tariffs, the better, but perhaps only a decision nullifying most presidential tariff forays by the Supreme Court will ever let that happen. The bottom line, as we head into the next week, keep in mind that we're stuck in the month of September, a historically terrible month for the market where bad news is bad news and good news is fleeting. It's not the end of the world, people, but it is an awful stretch of the calendar. Can we go to Leslie in California, please? Leslie.
Jim, club member.
Oh, fantastic.
Easy question for you, Jim. Northrop Grumman, buy, sell, or hold?
I'm going to say weak hold. I don't like the traditional hardware defense stocks, particularly if they're up a lot, which happens to be the case of Northrop Grumman. So I'm a little profit taking there. It's a little market above the market multiple. Let's go to Ty in Arizona, please. Ty.
Hey, Professor. Booyah.
Booyah. Right back. Thank you for giving me tenure. How can I help?
I'm a little bit worried about this company. I've owned them for a long time. They aren't growing, in my opinion, at the right rate. They're not doing much. I just don't see the leadership behind this, in my opinion, doofus Steve Squeri. What do you think about American Express?
Oh, my God. I think I'm going to have to, I don't like to come out against our viewers, but I'm going to have to be 100% against you on this. I think Steve Squeri is a remarkable executive. And I am hard-pressed to criticize a company that hit an all-time high on this very day. So I'm saying, buy. All right, going into next week, remember where we are at this point in the calendar. September is historically a bad month for the market. And while it's not the end of the world, it's usually a real tough stretch for stocks. Kind of keep that in mind. On Mad Money, football season kicked off last night with my beloved Eagles beating the Cowboys, and every year we like to start the season with a fantasy football stock draft of our own. I'm sharing the players and the stocks that I'm picking. I'm a little longer on the players than the stocks tonight. Okay, then Reddit and Robinhood just joined. Hey, Robinhood, by the way, just joined the S&P 500. Have been hotly debated on Wall Street, but how is the consumer feeling about those two names? I'm getting the latest from the data company 100X. And Lululemon got crushed today after earnings. And I think that was really a sign that could have been predicted. Well, I'll reveal what it was. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
With the football fantasy season officially kicking off last night with my beloved Eagles beating the despised Dallas Cowboys, who, well, not my faves, aren't worth spitting on. That means it's time for our Mad Money Fantasy Stock Football Draft. We do this exercise every year because, look, I just think it's a great way to educate you. Building a great portfolio has a lot in common with building a great fantasy football team. Plus, we have a terrific track record with these picks. Now, the 11 stocks I recommend as part of last year's draft are now up roughly 55% on average, absolutely trouncing the S&P 500. But enough looking backwards. Let's get to this year's picks, starting with the all-important quarterback position. Now, from a fantasy football perspective, what you want from the quarterback is steady production. In most fantasy leagues, there's only one active quarterback on the roster. So they need to have a solid performance week in and week out. And that's why I've long said that Apple, the original own it, don't trade it stock, is like the quarterback of your portfolio. Now, Apple ended up being one of our worst performers in our fantasy football stock basket over the past year with a measly mid-single-digit gain, barely trailing the S&P 500. But you know what? I'm not going to be easily shaking off Apple. It doesn't bother me. The stock's in fantastic shape. Again, you know, it's up over 41% from its April lows. The company seems to be back in the good graces of the Trump administration. The judiciary hasn't blocked them from taking billions of dollars to make Google their default search engine, and Apple's sales are growing again. That's why it remains a huge position for our charitable trust. As long as they can keep doing pay to play with, where you don't have to worry about the company's AI strategy, well, they'll just do what they did with search and make a fortune in the process. Maybe it's more than $20 billion a year from Google. So who's the NFL equivalent of Apple this year? Well, I've got an outside-the-box pick this time. Yes, I was drafting from my own league, Cincinnati Bengals quarterback Joe Burrow. He fits the bill with the potential to fully realize his what I think could be an MVP conversation. Let's say conversation, there's a lot of good quarterbacks. Now, Burrow finished last season with nearly 5,000 yards and 43 passing touchdowns, leading the league, in both categories. But I think the analogy fits because Burrow had so much noise to his story last year. Top target, Jamar Chase, more on him in a second, missed training camp last year. Team started the season very slowly. Bengals defense stunk all year. And so the team was scrambling to try to make the playoffs, ultimately falling short. In other words, the Bengals had a lost year, just like Apple did. But in the offseason, the Bengals reached contract extensions with both Chase and their other top receiver, T. Higgins. Teams playing more of their starters this preseason, avoid another slow start. And it finally feels like everything's coming together for Burrow to have both another strong season. That's why I think Joe Burrow is Apple this year. I'm expecting big things from both of them. Although when I met Burrow last year at the Super Bowl, I got to tell you, it would have killed the guy to smile periodically. Jeez. Now, next, let's talk running backs, which are the workhorses of your fantasy team. You want steady production from your backs, including lots of touchdowns, no matter what defense you're playing or what the weather's like. But I've said before, this position is inherently kind of boom and bust. Running backs get hurt all the time, and the best running back often changes from year to year. But the running back position has also changed in recent years, as pass-catching running backs are now the top options for fantasy teams. That's sort of like what we're looking for in our stock picks. For pass-catching ability is like a secular growth theme for a secular company. And that helps it keep staying if, like, say, the Fed doesn't cut rates fast enough. So what are the analogs here? Well, last year I included GE Aerospace, and that turned out to be a great pick. Thank you, Larry Culp, up 70%. The commercial aerospace boom remains one of the market's fantastic secular growth stories. So we're going to stick with a pick. But what's the NFL equivalent of GE Aerospace this year? As we're spending as much time on the players because it's just like, what can I say? It's our season. Let's keep things going. Keep it simple. The league's best running back is Philadelphia Eagles' own Saquon Barkley, who finished last year with over 2,000 yards rushing, tops in the league, added plenty of catches. It was better last night running than catching. What's the analog here? Well, come on, it's an aerospace company, and Barkley can fly. How about some other running backs? Remember, we're looking for industrials that have exposure to secular growth drivers. So what about RTX, which is the old United Technologies aerospace business? It's been merged with the old Raytheon. Aerospace and defense are both working here with Trump's bill, including $1 trillion of defense spending. Maybe we should say war spending. call it the Department of War instead of the Department of Defense. What's the NFL's analog for RTX? Let's go with Detroit Lions running back Jahmyr Gibbs, who is so good. He finished the season as the top fantasy running back last year. Why? He may have trailed Barkley by nearly 600 yards rushing, but he finished as the top running back because he also added 500 yards receiving and 4 touchdown catches. And that's why the comparison works. RTX has 2 growth themes. Gibbs can hurt opposing defenses in 2 different ways. Finally, unless you've been living under a rock, you know that we got this gigantic bull market electricity production to keep all these AI data centers running. And that's why we're looking at GE Vernova, the power business of the old General Electric. Makes huge turbines for power plants. They pronounce it turbines, so I do too. Best performing industrial in the S&P over the past year by a wide margin. This charitable trust name has been walloped of late ever since the president came out hard against wind subsidies, as Vernova has a wind division. But it's chiefly a natural gas play for what you that's why you own it for. Maybe it'll bottom as people realize that's let's say the salient division. And if you want power, the NFL comparison is obvious. We're talking about Baltimore Ravens running back Derrick Henry, who quietly finished not far behind Barkley last year, over 1,900 yards rushing. The risk with GE Aerospace is that you're too late, right? I mean, the risk to Henry is that time will catch up with the 31-year-old running back. But I think both are worth the risk. I really like the Ravens here this year, too. Finally, how about the wide receiver position? As I tell you every year, wide receivers are all about growth. When they hit big, they really hit big. And you can make your whole week in fantasy it's why you have to go for a stud wide receiver at the top, no matter if you don't want to. Good growth can make your year as part of your portfolio. NVIDIA, therefore, has been the stalwart, even though it's down 5 of the last 6 days. Oh, boy, I guess it's times have passed for NVIDIA. But you know what? I don't care. I say ain't broke, don't fix. Who's the NFL equivalent for one of the greatest stocks in history? I can only mention the aforementioned Jamar Chase as the NVIDIA of your fantasy team. He cemented himself as the best receiver in the league last year, which is why he's now the highest paid non-quarterback in league history. So Chase is now expensive, just as NVIDIA seems expensive at any given time. But when you look back, I bet they'll both be worth the price, meaning that the price-earnings multiple turns out to be not that high as the earnings continue to ramp. Next up, I like Alphabet, one of the best long-term growth stocks that you could have owned over the past 2 decades. The comp here is Justin Jefferson. He's the Vikings receiver that finished as the second-best fantasy play at the position last year. I will not do a dance that you just have to take my word that I like them. I think of both Alphabet and Jefferson as known commodities with major new questions. For Alphabet, Google's the worry is how's the advent of AI going to impact the core search business? So far, so good, though. For Jefferson, the concern of how he'll do paired with second-year quarterback J.J. McCarthy, who missed the entirety of his rookie year with a knee injury. Both concerns are legitimate, but probably overblown. I think they'll both be just fine. Here's the bottom line. Now that you've got your quarterbacks and your running backs and your wide receivers, stick around after the break for the rest of your fantasy stock football picks. Mad Money is back after the break.
Coming up, lock in those picks. From special teams to tight ends, Cramer's rounding out the roster for his fantasy stock draft. Next.
Earlier in the show, we kicked off our annual fantasy stock football draft, where I try to show you that putting together a diversified portfolio is a lot like putting together a fantasy team. I've already covered the quarterback, running back, and wide receiver positions. Now it's time to fill out the rest of the roster. Next position, we got to have a tight end. It's kind of a hybrid position. Tight ends are part blocker, part receiver. That's why to fill this spot, we want a stock that has defensive characteristics, but also has some growth potential. Typically, I go with something healthcare here, but that group is down in the dumps right now. So instead, I've got kind of a new one, a growth utility. Southern Company. That's right. Utilities are classic defensive names. Even in a softer economy, everybody has to pay their gas and electric bills. Usually these are slow and steady stocks with generous dividends. But anyone who's been paying attention over the past couple of years knows that things are changing in the sector. With the advent of AI and the great data center build-out, we're seeing tremendous growth in demand for electricity. So suddenly many utilities are traded like growth stocks. And that includes Southern Company, with regulated electric utilities serving about 4.5 million customers in 3 states, regulated gas utilities serving roughly 4.4 million customers in 4 states. At the same time, this is also a competitive power generation company and a leading distributed energy infrastructure company. Just for a second, we'll explain this. For years, Southern Company had an overhang from a gigantic nuclear power plant construction project in Georgia. The overruns were outrageous. billions and billions of dollars over budget. But that project was finally completed a year and a half ago. Ever since then, the stock's been on fire, especially with Southern companies all about the Southeast, where we're seeing a lot of new manufacturing. It doesn't hurt, pays 3.2% yield. So what's the NFL tight end equivalent for Southern Company? Oh, well, that is easy. It's Las Vegas Raiders Brock Bowers, who's, as a rookie last year, finished at the top tight end in fantasy. As a rookie, compiling 112 receptions, almost 1,200 yards, and 5 touchdowns. While Bowers is entering his second season with the Raiders, don't forget that he went to the University of Georgia. Oh, that's the somewhat tenuous connection to Southern Company, where he won 2 national championships in 3 years for the Bulldogs. I'll go one step further. While Southern Company had the overhang of a long-running nuclear power plant project, Bowers has the distinction of a distinctly suboptimal hairline that belied his youth and athleticism. But just as Southern Company removed his overhang by completing the nuclear plant project last year, Bowers has resolved his overhang by arriving to training camp with a new haircut. Brock, listen to me. Bald is beautiful. Don't let anyone tell you different. The final offensive position on most fantasy football rosters is the flex spot, a unique concept of fantasy football, which can be filled with a running back, wide receiver, or a tight end. The goal is to just get as many points as you can, however you can. With that mandate, you got to fill this flex spot with the most controversial stock maybe of our era, and that is Palantir. It's also one of the great growth stocks of our year. After pulling back in recent weeks, it's still the second best performing stock in the S&P, more than doubling year to date. And the stock is an army of retail investors who seem inclined to view every dip as a buying opportunity, although it's been stuck in the 150s for a little bit here. The NFL equivalent is Devon Achane. Yes, that's the running back for the Miami Dolphins, and not just because many people struggle to pronounce his name, including me. Now, I like the comp because as Achane finished as a top 10 point getter among a large pool of options for the flex spot last season, he did so with both rushing and pass catching. And that reminds me of Palantir. Regular viewers know that when we talk about this defense and enterprise software company, it has one of the best rule of 40 scores, if not the best ever. This unique way to measure software companies, Palantir, and Palantir's numbers are stunning. Now, both Palantir and Achane have risks. For Palantir, the risk is that the stock's nosebleed valuation will catch up to it. Some people feel that that's happening right now. For Achane, the worry is that the Dolphins' quarterback gets hurt again and their offense goes stagnant. But I think both are attractive as a high-risk, very high-reward options for your portfolio or fantasy team. Let's round out the roster with a defense and a kicker. In fantasy football, what you're looking for from a defense is consistent quality, because you can lose points if your defense gives up too many points in their game. And you also want upside, which comes from points earned for sacks, turnovers, and ideally defensive touchdowns. Pick 6. Call me a homer if you want to, but I'm going with the Philadelphia Eagles defense this year. Last year, the Eagles D finished first in the league in points allowed, but it was only the 5th best fantasy defense because it lagged some others in upside categories. Right now, so far, it's ahead in penalties. So if the Eagles can keep the same stout defense against yards and scores, but just maybe add a few more sacks, takeaways, touchdowns, they're likely to finish the top 5 again this year. For the comparison, we're going to keep it local, all right? We're going to make it J&J, New Jersey's own, which, if you haven't noticed, has been on fire lately. J&J's up roughly 23% year to date. I couldn't believe it. So it was like 180. It was amazing. Weak action throughout most of healthcare, not affecting these people. Their core pharma business is roaring. Terrific oncology franchise. Medical devices really strong now. That's why J&J keeps putting up good numbers. And they don't have that lawsuit as much as it used to be front and center. It's not anymore. Now, both the Eagles and J&J do come with some risks. The Eagles lost some depth at the cornerback position this season. In theory, they could lag again in sacks, turnovers, and touchdowns. The cornerback situation is really bad. J&J, the company's still not quite clear of all the talc litigation headaches. But at the end of the day, I expect the overall quality of both franchises to win out. Eagles got to get a better quarterback. Well, finally, let's round out our team with a kicker. This time I'm taking a trendy pick, the Jacksonville Jaguars kicker Cam Little, a 6th-round draft pick last year. It's rare for a kicker to be drafted, especially so early. He had a decent, not spectacular, rookie campaign, making all 27 of his extra point attempts, 27 of 29 field goals, but he only finished as the 18th best fantasy kicker, largely because the Jags' offense was so putrid that they didn't even have enough attempts. But Little turned heads a couple of weeks ago when he connected on a 70-yard field goal in the team's first preseason game. With just a little more quality play from the Jags' offense, I think Little could be in for a stellar season. Not bad. As for the stock market equivalent to Cam Little, how about CSX? the railroad company. I'm not saying this because CSX is based in Jacksonville, but because the company is widely considered to be in play. The merger-friendly Trump administration looks ready to approve transcontinental railroad deals. Union Pacific already trying to buy Norfolk Southern. And now many speculate that CSX could be doing the same thing with Canadian Pacific or Berkshire Hathaway's Burlington Northern. Now, we know there's an activist shareholder pushing for some kind of deal, which would be like a 70-yard field goal as far as I'm concerned for CSX shareholders. To be sure, I like CSX because I think Joe Hinrich is running a great railroad, right? Anything takeover related, icing on the cake. Bottom line, that's your full fantasy stock football portfolio. Just like in fantasy, you need to fill every position with the best that you can get. Play your studs. And let's go to Josh in Vermont. Josh.
Booyah, Jim.
Booyah, Josh. What's going on?
Congratulations on the Eagles win.
Thank you. It's a W is a W, as I like to tell myself when they're not that pretty. How can I help?
Awesome. I have a small position in DraftKings. And with football season upon us, I was wondering if it is a good time to buy more.
Yes. The answer is yes. I think this is best in show. I think that the stock could have look, it's up 25%. I think it can go even further. It is profitable, and it's, I think, run by maybe the best in the entire industry, Jason Robbins. Good choice by you. All right, the mindset for drafting a fantasy football team and creating an investment portfolio, I find pretty similar. You need to go out and you got to find the best breed companies in every sector, just like you would for every position on the football field. Much more Mad Money Head. From Starbucks to Reddit, I'm hearing how the consumer views some of the market's hottest stocks with data company 100X. Then, sinking nearly 20% just today alone. What the heck happened to Lululemon this quarter? I'm telling you as I see it. And, of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. With so many expert voices right now offering totally contradictory opinions on this data to the consumer, sometimes I like to get a more unique take from alternative sources of data that I think are very authoritative. And that includes 100X. It's a privately held alternative data firm, real-time feedback from actual customers on more than 4,000 brands. These guys have great insights because they collect information on purchase intent rather than purely projecting from historical data. There's a reason this company's data has been featured in roughly 450 Goldman Sachs reports since just last July. And they recently signed a co-innovation agreement with Deloitte to help deliver more strategic products. They're hot. So let's check in with Rob Pace. He's the founder and CEO of 100X to learn more about what we can from the latest batch of data. Mr. Pace, welcome back to Mad Money.
Thank you.
Rob, I find you pure joy for multiple reasons. One is because I like to take your information and meld it with my information, figure out what we should pay for the stock and whether we should pay up for the stock, the PE multiple. And I want to start with one that we have liked because we think that, frankly, the stock is a terrific thing, but a lot of people don't believe us. We like the stock of Reddit. People think that Reddit is just the kind of crazy stuff on message boards. It's not.
No, our data, including our latest August data, supports your thesis. So let me tell you why. So first of all, future usage, in other words, I currently use Reddit. Am I going to use it more? Continues to move up and take share from other platforms and community. But more importantly, Jim, is why. So the why is it's real humans helping you make decisions. So they're 20 points higher on information. They're 20
points higher versus
favorability versus the competitors.
Right.
On does it give me relevant information, et cetera. Now, here's why I think your thesis, and we're not stock pickers.
I know, but that's my job, but I need empirical backing, or else I feel I don't want to just use Wall Street research.
No. Here is the melt-up strategy, right? So when we stitch together a few things, so real humans helping you make decisions. That's our data. Now, people hate search and those dreaded blue link sponsored paid search. We see the world moving from sponsored links to customer earned links. In other words, as AI proliferates, the answers are going to be, who do the customers say and that's what's going to link out. And Reddit, if they get a share of that, that's a $1 trillion profit pool. So the melt-up strategy is the world moves from sponsored links to the truth. And ironically, human intelligence, Reddit, is going to pair with artificial intelligence to be the solution.
Well, I know that their affinity nature brings out people who want to help other people within the cohort. That's highly unusual.
Yeah, that's a human human characteristic, right? And that's why we're pretty bullish that you're not going to replace decision making with machines, but rather human beings.
All right, that's great, because I feel better, because a lot of people say, Jim, come on, it's all the way to 200. I think it can go much further. Now, another one that I'm really, really keen on, but your work crystallized why I should have been keen versus just looking at the numbers, is Robinhood.
Yeah, so in our data, we now get more feedback on Robinhood as a crypto play than a traditional broker. Now, as a traditional broker, they do some things very well, their app and the trading, et cetera. But when we look at them versus the competitors on the crypto side, they're pretty dominant. So if you're bullish on crypto, you're bullish on Robinhood.
Now, I think that a lot of people look at Robinhood and think that they're just a bunch of gunslingers, but maybe it's that gunslingers away. What matters is that people regard what they trade there as being more authoritative versus, say, even if they went to our alma mater, Goldman Sachs, if they want to trade crypto.
Well, yeah, they're sort of a new era platform, and I think this is their moment.
Yeah, definitely. Now, one other that we regard as a long-term that I spend a lot of time on is Starbucks. We own it for the charitable trust. We have no short-term expectations other than the fact that we think that it's a little bit faster when we go. It doesn't seem like we like the pumpkin spice latte. We would love to know more empirical than just our own anecdotal that we think is getting better.
It is getting a little better, but it's been a long turn. So our data on them bottomed around March or April, meaning compared to the peers, the coffee peers, the breakfast peers, et cetera. And it's now trading in line, and it's starting in terms of customer feedback to improve. So here's what we see in the data. And obviously you have an elite CEO in terms of track record. So that's the X factor that you factor in.
Absolutely. Brian Nichols, sensational.
Okay, they're making progress on speed. They're making progress on attitude. But we see the battleground in our data is they're a little better in taste, and a little better in products, but price is a lot worse. So
really, because we need that most value. You've taught us about MVP.
Yes, this is the Deloitte introduced framework that we love based on our data, not theirs, our data that says, do you provide more value for price or not? So here's what we think. They're going to fix the experience, right, the speed, but we see the battleground as product. So I was very excited when I read, I think yesterday, that they're going to introduce protein, right? Protein drink. So they're going to need to win. Starbucks is going to have to innovate on the product side, not just the green apron, not just the neighborhood cafe in our.
The good news, I think, is that Brian Nichols recognizes that. Like, maybe they need to come up with something new for the day part where there's not much that's exciting. Or maybe look at pumpkin spice. They got to come up with other seasonal drinks, and that would be jiving correctly with what you're seeing. I know it isn't in our pack, but were you surprised to see people turn, in terms of most valuable player, turn so hard against Lululemon?
Yes, and just one thought on Starbucks to complete your thought. Almost all our feedback when we read it, it's what we call wet orders. It's about the beverage. A big opportunity is the dry orders, the food and the beverage, right? A lot of opportunity for innovation there. Okay. So Lulu.
I have to do just because it was so stark today. Topical. I know that's because of the three I wanted to talk about. I have to just say that your work would describe, if you were to come in here, like maybe we see each other next, is it possible that you could ever have a turn? It seems so bad.
Yeah, so their strengths, quality scores are 20 points more favorable. So if we put together a composite like Viore and Athleta, et cetera, so their strengths. The problem is back to this MVP, right?
That's what I thought.
Price isn't justified by the quality. Others have caught up on sizes and fit and products, and I thought the CEO was right. I think it's more than tariffs; it's product cycle.
Yeah. Well, I do think that just as you. For Reddit, I totally agree. Okay. I think that Robinhood is very, very exciting for many of the reasons you talk about. And Starbucks is this work in progress. Right. We own that, and I feel very good about it, but I can't jump up and down and say, now it's done. Right. Too early.
You know, what we're seeing, and there's 4 or 5 of these iconic names that killed it for a while and have fallen out. They've got to not do the old thing. They got to find the new thing.
I hope Brian's watching because I think he feels the same way. That's Rob Pace, 100X founder and CEO. And you know, as a stock picker, I love to hear this kind of empirical data that Rob brings because you're out on your own when you buy stocks. And when they come down, you have to fall back on the stuff that you're talking about because the numbers themselves might be coming in, but maybe the franchise is worth a lot. They have money's back in the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time to talk about lightning round. Okay, let me say, but talk about myself. My staff members will play this out. And then the lightning round is over. Are you ready, Ski? That's over the lightning round. Cramer, let's start with Sam in Massachusetts. Sam.
How are you?
I'm doing good. How about you, Sam?
I'm good. You know, Jim, more often than not, when I see a stock that's trading at a discounted level, I'm curious as to why that is. And more often than not, I find that it's cheap for a reason. So I was looking through the industrial sector, given the elevated valuations of some of these companies with the AI boom, and I came across Perform Line Products Company.
Okay.
The company is trading at $1 billion, yet it's doing fantastic. And relative to its peers, I think this stock is undervalued.
Okay, which stock?
TLPC.
Oh, now you know what? That's still one more of multiple stocks that are involved in the construction of the data center. And those, because there's so many of them, they're starting to trade at a discount. Don't freak out. The business is good. I need to go to Ricky in Texas. Ricky.
Booyah, Jim! Or should I
booyah,
say
Ricky.
Secretary on Wall Street. This is Ricky from Frisco, Texas. First-time caller, long-time listener, and proud club member.
Oh, thank you so much. We had a good one with that Broadcom today. I love that. What's going on?
Hey, my question is about Albert Systems. Ticker symbol ESFP.
I know. I mean, the stock is just a straight-up stock, and I like it. I typically don't like foreign stock defense because it's harder to get a read on, but that company is very good. I've liked it for a couple of decades. Let's go to Ann in Indiana. Ann.
Hey, Jim. Thanks for taking my call. Club
thank
member.
you. Yes.
Maybe I'm just way too early on D-Wave Quantum. Buy,
No, we
hold.
actually, I have to tell you, we liked them very much when they were on, but you know what we really liked? We liked the quantum story that Arvind Krishna had to say when we were up at IBM. And that stock, by the way, is very inexpensive for where it's been. I think IBM gives you a lot more than just quantum. Let's go to Brian in Rhode Island. Brian.
Hey, Jim.
Brian.
First and foremost, thank you for the last 20 years for educating me and entertaining me. I really appreciate it.
Thank you. I hope you like
You're one of a kind.
How to Make Money in Any Market comes out at the end of the month, and it's a compilation of all the new thoughts that I have, trying to really get young people involved, too. How can I help?
Yeah, I'm calling about, I want to see if your love has changed for Intel after the recent government involvement.
Well, look, it's had a very, very big move. Now, I happen to really believe in Lip Bhutan. I think he's absolutely great. But the stock just jumped so much that I don't want us to get ahead of ourselves with Intel. Now we're going to go to Mark in Florida. Mark.
Hi, Jim. Big booyah from Florida. I've been a big fan for many years. Fourth time calling in. This stock has been languishing at $17 a share for over a year. Mr. Market doesn't want to recognize its great value. When will you have co-CEOs Tom Long and Marshall McRae on your show? We are talking about energy transfer.
Oh, I like that. Get 7.5% yield. It's a premier natural gas play pipeline. I think it's sensational. I didn't used to think that they were taking down too much debt. That's not the case. For years now, they've just been consistent. You got it right. Let's go to Jacob in Alaska. Jacob.
Hey, Jim, what's your take on this media company that just posted a 7% year-over-year revenue drop with management going all in on M&A and deleveraging? This company has announced over $1 billion in new deals this quarter, expanding into multiple markets and building a duopoly to boost local ad dollars, all while refinancing debt and repaying hundreds of millions. Despite these near-term headwinds, the stock has jumped almost 10% in recent weeks and 94% year-to-date. With the recent analyst upgrades and the announcement of new NHL broadcast rights and a streaming partnership with Google Cloud launching in January, what's your take on ticker GTN Gray Media?
They're a survivor. They're survivors. That means it's enough to be able for me to pull the trigger, not after the run it's had, but I've got to tell you, they're a survivor for a good spec even at this price. At that, and that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, was Lulu's loss Costco's gain? Cramer's highlighting a big missed opportunity from the athleisure company after its disappointing quarter. Next.
If you want to know why the stock of Lululemon plunged over 18% today, look no further than a lawsuit the company filed against Costco last June for allegedly selling virtually identical knockoffs. Lulu claimed that Costco is mimicking some of its clothes with imitations like the Kirkland 5-pocket performance pants, which can sell for maybe even as little as a quarter of Lulu's very similar product. Look, Lulu's a special company that makes special products, but I've never met a soul in the last few years that didn't say, within a breath of mentioning something that they liked, that of course it's very expensive. Have you ever heard anyone say something that something from Costco is too expensive? Have you ever heard of anyone say that it's not of similar quality to the product that it rivals, if not better? Notice, I didn't say mimics or infringes. I said rivals, because that's how the American people view the relationship. For the longest time, many Americans actually cared about specific labels like that of Lululemon. They were viewed as high-quality status symbols. But those days are gone. Somewhere along the line, we started viewing them as decent quality products that made us feel like we were dopes for paying full price. Again, when you speak about Lululemon, you always seem to hear about how it costs more than the last time you went. But the quality wasn't any better than the last time you went. Costco, you always feel smart because you know that nobody can tell the difference between Kirkland Signature and the name brands it competes with, except maybe they're better. Somehow, everyone seemed to know this except for Lululemon's management, which is why the stock's had such a sickening slide. Now, we can speculate about how Americans decided to go bargain hunting versus accepting higher prices. Perhaps it's because so many things started costing too much inflation, so we decided to take matters in our own hands by pivoting to cheaper products. Or it could be because Costco perfected the premium private label. So we don't care about the brand as long as we're getting merchandise of similar, better quality. Or maybe we just realized that no one knew the difference, including us. To me, companies like Costco and Amazon are avengers. They recognize that we're mad as hell and we're just not going to take these prices anymore. Now, that doesn't mean we won't pay up for premium goods. Do you know that people, I'm gardening this weekend, okay? I'll probably put on my Brioni. I say that because people make fun of me because I spend a lot of money and wear Brioni suits all the time. Sure, I like the way they look and feel, but you know what I really like the most about them? They last forever. I just wore one on air the other day that I originally bought 30 years ago at Neiman Marcus. You divide the price by how many times I wore it, and I got to tell you something, you got a Marshalls-like bargain. So let the decline and perhaps fall of Lululemon be a sign that Americans want value, not status. Or to be more positive, they want value and the status of not being seen as dupes for paying full price just for a brand name. If you're an apparel company and you can't figure that out, then take your prices down and stop trying to please both Wall Street and Main Street, because in the end, it's Main Street that makes the purchasing decisions and ultimately determines what Wall Street has to say, and not vice versa. I like to say, as always, a bull market somewhere. I promise I've been just for you right here on Mad Money. I'm Jim Cramer. I'm going to see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.